Rates are at an all-time low, historical lows. But you know what? It's a good question right here, DeLynn. When is the right time to refinance?
Pros and cons coming right up.
Hello, everybody. My name is Barry Horvath, and this is Moving Forward TV with your local market update.
And I am DeLynn Gaston. Thank you so much for joining us today. So as we all go through this COVID-19 thing together, this virus that we're all walking through together, and the quarantining and the safer at home and all of that stuff, as things are not necessarily ideal right now in the world. The other thing that happens, sadly, is scammers, right? Scammers seem to...
This was a rate show and refinance.
We're going to get to that. We're getting to that in a minute. But I did just want to touch on a couple of quick things. I wanted to talk about the scammers that are out there. There's a lot of scammers that are out there lately, and we just wanted to tell you a couple of things that we've heard come up. So, you've heard of the terms Fannie Mae, Freddie Mac, Federal National Mortgage Association, or the Federal Home Loan Mortgage Corporation.
So we're talking about Fraud Watch now.
Fraud Watch.
Okay,
So they will never call you.
Okay.
Let's put it that way.
They're kind of like the IRS.
And sadly, these scam people, as soon as something bad happens in the world, they all jump on it, right? Unfortunately. And they have jumped on, unfortunately, with the whole mortgage thing. We talked a lot about it last week with the forbearance and stuff like that. So people, these scammers have jumped on that kind of thing, and they're trying to call homeowners. And you might even see it coming up on your caller ID as coming from Freddie Mac or coming from Fannie Mae. No, it's not. They will never call you. Keep in mind, a scam person, they know how to work the phones and the system, and they can change the caller ID to anything they want it to be.
You know, sometimes I get calls on my phone. You ever get a call on your cell phone and it's from you?
No.
I get them all the time. And I'm like,
really?
Yeah, and it's like, you want to answer because why am I calling myself and who has my phone? You know, it's an instant thing. So, yeah.
So you want to answer, but
you shouldn't answer. Let it go to voicemail. So yes, with COVID-19 going on, obviously fraud is definitely on alert. We want to keep you on watch for it. We want you to just be aware of potential scams that are coming in because we know if you haven't watched last week's show, you ought to watch it because we talked about forbearance and how much they're on a rise, whether you should do it or not do it. You know, I'm going to reiterate, make it your last resort. If you're talking about forbearance, that's all I'm going to say about it on this week's show. Because we know that, personally, I think the cons far outweigh the pros. But because of all the forbearance that's going on out there, the fraudsters are coming up. So they could call you and make it look like they're from Freddie Mac.
Yes.
It can show up on your caller ID. Freddie Mac is calling you. And they're going to try and get you to divulge as much personal information as you can. And you're not even talking to Freddie Mac. So it's happening. We're getting the bulletins now. Be aware of it. Some of the things that you want to do is, first thing, like DeLynn said, be suspicious of caller ID. The next thing is hang up. We all know how to do that. When we get mad, we hang up. When Freddie Mac says they're calling you, hang up. When the IRS says they're calling you, hang up. And then always be suspicious. Don't trust the other person on the other end of the phone right away.
Or don't answer it. Let it go to voicemail. Don't answer it at all. Just let it go to voicemail because you know what? If it's somebody important, they're going to leave a message for you.
Yeah, so...
But these scammers usually won't leave a message.
So whenever you want to, you feel like you are going to do a forbearance and you're like, oh, I'm so glad you called, you know, no.
Red flag should go up.
Hang up the phone, go to your mortgage statement, get the phone number on there, have your account number ready, and make a call direct to your servicer.
Yes.
And
They
you're gonna
are
make-
not going to call you. They are,
Yes.
your servicer is not going to call you and ask you if you want to go into a forbearance. Not going to happen. So,
And if this
just
happens
heads
to
up.
you, I encourage you, I know we're all in this together, as you
Yes.
said earlier, report the fraud.
yes,
Do-
please.
Do yourself a favor, and don't be afraid to block a call. If you get a call, I know you said you got one from, telemarketers
Yes.
are getting trickier and
They are.
all the time. So
So the fraud call is 800-4, the number 4, fraud, FRAUD, the number 8. So
There you go.
1-800-4-FRAUD-8.
that's great.
And report it.
And you can actually call your phone provider and have them
Blocked, right?
filter
Can't
out
you?
and block out
Good, good.
those type calls. I know
And
now.
you know what? They come to cell phones now, too. So it's not just your home phone anymore. They're coming to cell
Look,
phones.
they're calling you now. Why does it say Freddie
Yeah, that
Mac in your
person I
phone?
do know.
That's so good.
Talk to you shortly, Sherry.
Great. Anyway, so there's our segue into, we're talking about forbearance and they're not going to call you, but, with all the hardship going on right now, it might be a great time to refinance
Right.
because, and I know, you're going to see all these rates online and people are going to tease you with, oh, I'm getting a 2% mortgage. I'm here to tell you, there hasn't been a 2% mortgage.
No.
There
Not-
hasn't been.
In my 40-year career, there has
hasn't
never been a 2%
There
mortgage.
have been some days where the upper twos did fall in, depending on the criteria, which we're going to share with you. So don't be getting taken in, and we're going to try and explain to you when does it make sense to refinance and when does it not. Well, when when we're in a situation like this, where most people's income has actually dropped right now, and if you
A lot
could
of
free up
people.
$200 or $300 a month on your mortgage payment, that could be the difference of you putting food on the table or
Right,
not.
right.
So
So when the time is not to refinance is after you've gone into a forbearance.
Yes.
We mentioned that last week. So once you enter into a forbearance, we can't refinance you anymore. There are really strict rules with that. So prior to considering that forbearance, like we talked about last week, perhaps try considering a refinance. The rates are great right now. They're not 0%.
And they're not even 2.
And they're not even 2, but they're great interest rates. They still are at an all-time low. So it might make sense to do that before you run into any issues.
Yeah, so when you go online and you see, a lot of you go on these different websites and
Yes.
I see people actually apply online and then they don't know, but they're selling their information to a number of different lenders and then they're all competing for your business.
I know.
you
And your
can have
phone is going to blow up
and
with
you
all
could
these
actually
people
have
calling you.
multiple credit pulls.
Yes.
And if you do that, that can hurt your score. And of course, ultimately, let's talk about the different things that
Yes.
can make your rate. And when
And
does
I'm-
it make sense to refinance?
And I'm a fan of going local instead of going on one of those, websites and you don't know, you're talking to somebody in California, you're talking to somebody in Michigan, and like Barry said, it's going to go into a system and then you're going to get multiple credit pulls. Next thing you know, people from California, Michigan, Arizona, Idaho, they're all calling you from all over. I'm a big proponent, and you know what? Somebody local, somebody right here in your own backyard, just talk to us. We're not going to run and pull your credit right away. We're going to see if it makes sense for you. And it doesn't make sense for everyone. But without pulling your credit, we're going to walk you through it and we're going to see if it does make sense for you.
So let's talk about the biggest factors that is a myth out there, I believe, in what affects your rate. So a lot of people aren't aware of it. So the number one
Right,
thing.
that's the first thing they do is call us and they say, what's your rate?
Yeah, what's your rate? Send me
Wrong
your-
question.
So for you real estate professionals out there that said send me your rate sheet, you need to watch this show.
No such thing. It used to be years ago,
Yes.
all banks and lending institutions had what was called a rate sheet. And here's what was every single morning we got a rate sheet. This is what our interest rates are for the day. Well, since credit scoring and everything else, that has long since been gone. And credit scoring has been around since my son was born 24 years ago.
Yep.
So we haven't had rate sheets in 24 years.
Well, and sometimes you can't right now, but when you walk into the bank of a lobby, it'll say today's rate. They don't
Right.
do that anymore. And if they do, it's based on the perfect criteria that they're looking for.
Right.
And the number one thing is, believe it or not, what affects your rate is your loan size.
Right.
So number one,
There's 6 things.
Yes.
There are 6 things. We want to make that clear. So you can't just call and say, what's your interest rate? I need the answer to 6 questions before I can quote you an interest rate.
I was on Facebook the other day, and this guy's like, I'm looking to refinance, and I'm looking for the best rate, 15-year, no cash out, rate and term, go. And people started quoting rates, and I'm like, okay, how
Did you
can
quote 2?
Yeah, I told him it was,
2.
I told him it's free. It's free. My rate is 0, baby. Come to me. Come to me. And people will lie.
Yes,
you know?
they do. That's the other thing.
That's
oh
really
my gosh.
sad.
It
It's really
is.
sad. So obviously loan size makes a difference.
Loan size is one of the 6 things that we need to know. The second thing that we need to know is value. Oh, I'm sorry, were you done with loan size?
No, I wasn't done with loan size.
Sorry,
because
go
there's
ahead.
something you need to understand about loan size. If
Yes.
you have like a $50,000 loan
Yes,
versus
good
a
point.
$200,000 loan, your $200,000 loan is going to have better pricing than your $50,000 loan.
Right.
Now, when you go over,
Why? Why is that?
because the servicer is going to make more money on you.
It all has to do mortgage loans or investments,
Yes.
are investments to Wall
Can you
Street.
say
So
that?
they
Can you say that three-
investments.
Can you say it 3 times fast? Investments.
So the cost of doing a mortgage loan is the same whether they're making a $50,000 loan or a $350,000 loan. So Barry's point is obviously they're going to make more money on the larger loan size, so they're going to charge a little bit more for the smaller loan size.
Yeah, so now if you get into the larger loans, the pricing can actually be worse than the ones what I'd call in the sweet spot.
And that's when we get over $500,000.
Yeah, so when you're over 510, you get into jumbo pricing.
Right.
Now you can do combo loans to get it down, a first and a piggyback second.
But that's a whole
lot
new
of deals.
show.
That's a whole show in itself, right? So keep that in mind. Your loan size is one of the biggest factors. So the next thing is
Number 2,
value of the house. So I'll let you talk about
Home-
what that means.
home value. So the value of the home, and I know that it, we haven't had an appraisal done yet, and we're just initially talking. This is in the initial phone call, and I'm going to ask you, what do you think the value of your home is? Most of the time, people know, or they say, well, Zillow says this, or Realtor.com says this, and that's great to give us at least a start, at least some kind of an idea. Well, I added a room, I added a built-in swimming pool, or something like that. Any kind of add-ins. I'll always ask them, when did you buy it and what did you pay for it? If you just bought it 3 months ago, and you paid $200,000 for it and you haven't done a darn thing, chances are it's still worth $200,000 or
Yes.
close to that. It hasn't increased a lot in value. But if you bought the house like maybe 5 or 6 years ago and you put a pool in or whatever other additions, now we've got some value in it. And it's called loan to value. So what is our loan amount versus what is the value of the house? The more equity position that you have, the better your interest rate is going to be.
Well, I mean, it just makes sense because
Right.
the risk to the investor is lower if you have more equity. You're
Right.
less likely to walk away from a house with a chunk of equity in it
Right.
than you are with one with no equity or minimal equity.
Right.
So the lenders take that into consideration.
And the sweet spot on that seems to be about 70% loan to value, right?
Yeah, I think-
Thereabouts, right
well,
around 70%
and it can be better when you get below
or better.
70.
But even,
you
we have
see
a
rate
couple that are
improvement.
below 50% loan to value, and those are really,
Those are really sweet.
yes, they
right
are.
now. Yeah. So value of the house is number 2 on our list.
Yes.
So loan type. This
Number
is a
3.
biggie. This is a biggie right now.
Yes.
Your loan type really plays in, and when I say loan type, I mean like FHA, VA, conventional,
USDA.
USDA.
That's pretty much it.
Those type of loans make a difference on the rate.
Yes.
And it seems like right now conventional is kind of in the sweet spot because
is.
government loans they're not in favor right now. But if
Right.
you don't like it, wait a minute.
Right.
And then
It used to be government loans were better priced.
Right.
Now,
now
conventional loans are better
now
priced.
It's definitely different. So, and the other thing is it cash out? Are
Right.
you looking for cash to do home
and
improvements?
that's a
update
big difference.
So yeah, if your credit score is okay and you're trying to do cash out, while you might get approval, your rate is going to be significantly
Yes.
worse than if you're going to just reduce your rate and term
Yeah.
on it. And of course, the other thing is 15-year versus 30-year.
Right.
And people have asked me about 25 years because I've already paid 5 years. I want, usually there is no really pricing or market right now for a 25 or even a 20-year loan.
Right.
You're better off probably sticking with the 30 rather than go with that. A 15-year will typically give you a little better rate.
Not much, though.
No,
It's
it's
surprisingly
not.
enough, it's not that big of a spread right now because, again, keep in mind that these are investors on Wall Street who are investing in mortgage-backed securities. Honestly, they're not interested in 15-year paper. They're just not, there's not a market for it right
Yeah,
now.
they want that 30-year note right now. But
Yep.
if you don't like it, what we're telling you, just wait a minute.
Right.
You know.
We watch this stuff every single day, people. So, it's and the cash out, I've had people call me and say, well, I just want to refinance. And then, we quote a rate and we start going and they're like, well, I'm thinking of maybe, paying off some credit cards too. Can I get a little extra cash out? That changed the whole dynamics because now our loan amount's going to be higher, which means our loan to value is going to get less. And investors look at it as a little more risk because you're pulling some of that equity out. So it's going to be a little bump in pricing.
Yes, it definitely makes a difference.
Yeah,
So.
that's
All right, so let's talk now. We talked about loan type. Let's talk about the next thing.
number 4.
Your property type. Property type is big because manufactured home.
Is a big difference
Big
from a
difference.
regular
Yep.
stick-built house, they call
A
it.
condo makes a
Yep.
difference. Single family, duplex, multiplex,
Right.
quad, all those things.
And owner-occupied versus non-owner-occupied property.
Yeah.
Investment properties. Investment properties are always going to have a little bit higher of an interest rate because it's a little riskier for the lender. It's not your primary residence, it's the rental property. Things get tough, first thing people let go is the rental properties.
Yes.
Right?
Yep, they do.
So that makes
it's
a big difference as well.
Higher risk. So, and then of course,
But yes, we are doing manufactured homes, if I can just interject. Yes, we do manufactured homes.
she does them.
But there is a little bit of a,
There's a rate adjustment
A-
for it.
of a rate
but it is a
adjustment.
higher risk because they don't have the built-in appreciation that
right.
single family does.
Right.
So, good point. All right, now another factor going in to your pricing and on a refinance is your property zip code and what state you may be located in.
Right.
Now, back when the market was collapsing in 08, 09, if you recall, certain zip codes had a higher risk than others. So the pricing was actually higher. And you might go online and shop and you might find an Ohio lender and the rates can be totally
Two.
different in Florida. They're all 2 in Ohio. Because I don't know why, they just get better
They're
rates
2.
than us. You know? They don't
Ohio
drink.
has
They
2.
don't drink Corona. They drink Natural Light in an aluminum can. It's safer. That's what they tell me.
And the rates are 2.
And the rates are too. So it's a different world. So your location.
But you're right, it is different.
Yeah, the location of the property can definitely determine the rate.
And why is that?
It's all risk based. Yeah,
Yep.
it's all risk based. So.
And then the last one, number 6, and you notice that we waited all the way to number 6 to tell you the very last thing that affects your interest rate is credit score. So that's usually
Yeah.
the first thing. Oh, people
My
tell me,
credit's great.
my credit's great.
Yeah.
Can I get that 2% interest rate?
Yeah, it's all you, baby.
No.
all
Need
you.
all of these other questions answered as well. So it's not just rate. People think that just because you have perfect credit, great credit, you should get the best rate. That's not the only factor that goes into it. So
And you know what? It doesn't matter if you're self-employed or W-2'd on
Yeah.
your rate. That doesn't impact at all.
And it doesn't matter how much money you have in the bank. I had
Yes.
somebody else who called and said, but they retired with quite a lot of money in the bank, but that is not going to give them a better
That's
interest
going to
rate
get
just
them
because
maybe approved. That's going to be a compensating factor.
compensating factor, but
if
that's
your
not
credit's like
right.
iffy, and of course, if we're going to get an appraisal waiver, we're seeing a ton of those.
But
right
you
now.
know, the funny thing is, people, and I'm not saying people watching are, but I have had people who were surprised to find out that their income and their assets were not on their credit report. So that is not something that they're like, well, yeah, but I make a lot of money. My credit score should be higher. Your income is not reported anywhere in your credit report. Or I have a lot of money in the bank. My credit score should be higher. Again, your assets that you have in the bank, your portfolio does not affect your credit score. So
You could do a whole show on credit.
I
in
know, we
itself.
could.
You
We
know, so-
could.
and you know what? Right now, speaking of, so since we're on credit, And I want to talk about when does it make sense to refinance.
Yeah, I think we should too.
Your credit scores right now actually are loosening up. So I wanted to make sure
little
we
bit.
didn't mention that, because with COVID, if you remember, the criteria went up to 640 and even
Right,
660.
was the
And
minimum
some
scores.
lenders are up there on the government loans. I've heard a couple of the big ones went to 700
Wow.
credit score now.
The big banks, right?
Yes, yes.
Yeah.
We're back down to 620. Seems to have stabilized in there. We were doing 580, but
Right. 580s are not back yet, but the
other
620s
thing,
are.
And if you're not an essential worker right now, you may not even get funding. So keep that in mind if you're trying to refinance because you're desperate to save money. Keep that in mind right now. So.
But just call us and we'll walk you through it without running. The first thing
Right.
that some lenders do when you call them is run your credit. That is like the last thing we're going to do. Notice it's last on our list because
Yeah.
we want to find out if all of the other factors fit. The pieces have to fit just so together. When we're talking about interest rate, the sweet spot there seems to be over 700, to be perfectly honest with you. With
Right.
the interest rates that are the credit scores that are under 700, definitely a big difference in pricing.
It definitely is.
But again, it depends, if you have a credit score, let's say of a 670 or something
Right.
like that, 675 credit score, but you're at like a 50% loan to value, you owe 100,000 and your house is worth 200,000. You probably will get a decent rate. But if the house is worth 200,000 and you owe 190 and you have a 670 credit score,
Bada
your rate,
bing.
yeah, your rate's going to be a little bit higher.
Yep.
So,
All right, so when does it make sense to, now that we've told you how it's all calculated, it used to be a rule of, if I drop my interest rate by 2 points, I should refinance.
yeah, that is wrong.
Yeah, and that's like 6%, you need 6% for closing costs. That's wrong too, but
Yes,
that's another show.
that's wrong too. That's another show.
When does it make sense? Well, first of all, you need to consider there are no cost refinance programs out there, but you are paying for it.
Right.
So what happens is the lender does what we call a par plus pricing, meaning if everybody else is getting 3.5%, you might pay 4.25%, and they'll give you a credit towards that closing cost. You don't necessarily see it, but you do pay a higher rate. That's one way to look at it. So if you're going to lower your rate, yeah, that may make sense for you if you plan on moving in the short term. But if you're going to hang on to the property for any length of time, remember, there are closing costs in any refinance, whether it's built in the rate or you're paying them.
Right.
Or, and they typically, most lenders will just add it on the loan.
And the reason for that, just so that you know, it costs. It costs when you're doing a loan all over again. It's just like when they did it the first time. The title company still has to do their job. They get paid to do their job. Underwriting has to get paid to do their job. Processing, the recording the documents in the county clerk's office. All those things happen all over again.
They all play in.
They all play in. They all have to get paid to do their job again.
So here's a simple guideline, rule of thumb for you. Take your closing costs of whatever they may be. Let's just say they're $4,000, hypothetically.
Right.
Okay? Forget about the escrows, because you are going to have to most likely replenish your escrows. Take those out of the equation, because you're going to have to pay them at closing, but you're going to get them back from your current lender.
Yes.
It might take 2 or 3 weeks after you close, but you will get them back if there's escrow money there. If the closing costs, let's say you're saving $100 a month on your payment, and it's $4,000 of hard costs for you, and you save $100 a month in your payment. Common sense, your break-even point is 40 months. Are you going to stay in the house 40 months or more? If the answer is yes, you probably should consider refinancing it.
Right.
And most people are like, I might sell next year, and they never do. They don't know what life's going to bring you. And what you do with that payment savings can make a huge difference, because if you're only, if you're saving $100 a month and you're paying off other high-interest credit card debt, by golly, it makes sense. You're okay with, you got a $10,000.
Right, that's the other
This
thing.
is what doesn't make sense to me. People pay
Here he goes. Fair warning.
23% on a credit card on a $10,000 balance, okay?
Right.
Okay? And they're paying $2,300 a year of interest. They're okay with that. But they don't want to pay $4,000 in closing costs. They're tacked in their loan to save $100 a month. You know, at what point you're like, hello,
I know.
hello. You know,
I know.
So if you take the payment savings and pay off higher interest debt, makes sense in my mind almost all the
Absolutely.
time. If you want to invest the difference with the market being so
It's another
volatile
great-
right now, and put it aside and make that same budget for your payment amount and watch your money grow and compound, you could pay off your mortgage sooner. Or if you're just one of those people that just want to pay off your mortgage, if you make that same payment amount, because mortgage interest, you pay all the interest up front. It's amortized interest, okay? You accelerate how fast you pay off your mortgage if you're paying extra principal. Common sense. Am I a fan of that? No, but it's better than not doing anything.
Right.
Because if you keep doing what you're doing, you're going to keep getting what you're getting.
Right.
That's common sense. So if you're excited about your financial position in life, don't even listen to us. But if you want to make some improvements, take our advice. Because, even if it's $50 a month and you do the right things with the money, it can make a huge. It really can drastically change your
Right.
life long term.
Right.
So there's my soapbox.
I
okay?
know. I thought you were going to go further when you got into the credit card debt.
No, because I just
That is one though that gets me too. I've had people say to me, "Well, I don't want to add that into my loan. I don't want to
You
add
wanna
that
be
into
in
my loan.
debt?
I don't want to be in debt." Like, wait a minute, you're already in debt. I'm just showing you a better way of paying it back.
I know. You know what?
Sometimes they don't get
You
it.
can
Keep paying
actually-
23% or pay 4%.
I
Which
have-
one do you want to do?
I have shown people in illustrations where that simple payment savings and putting it away long term compounded.
You
they-
showed me that.
and you could pay off your loan, a 30-year note, in 12 to 17 years,
Right.
making the same payment you are today.
Right.
And
But just paying less interest.
exactly. And remember this: for every 1 point of interest that you're saving, if you have a $100,000 loan, common sense, first year, how much interest are you going to save?
$1,000.
Is $1,000. So it can make a big difference. Now,
Up
if you
to
have a $300,000 loan, maybe a half point is $1,500 a year in interest savings.
Yeah.
Might want to look at it. Don't look at how much the spread is. Look at what you're doing with the money and what that payment savings can do for you.
Right.
We're going to get you to financial freedom. We're all about it.
And it could, I know we're running out of time, but it could also pay off. So you're saving, $100 a month. Take that and chunk it down on your $10,000
Yep.
credit card if you didn't want to include that in
We
with
already
your
told them
refi.
that. All right. Hey, check out our Lunch and Learn on the 28th, okay? We got the
Yes.
Zoom meeting. We're up. So thanks, everybody. Share this. Tell your friends
Like
about
us, all that. We are today and every day.
it. Moving forward. Have a
See you
great
next
week.
week. Bye-bye.